Okay. Yeah, it's great to reprise on some conversation about China. I am super happy and grateful for my good friend and former colleague Nick Lee, who I'll do the brief introduction for him. He's been at Morgan Creek for a long time and runs the China Fund there. But we spent a lot of time on the road. He's a great guy. I am really looking forward to hearing what he has to say, as well as Stephen. So I'm going to try to get through mine relatively quickly. As always, slides will be available. So let me put up here. All right. Okay. My compliance people will be happy that I'm showing my disclaimer here. These are my opinions. So a chart actually that Nick and I are quite familiar with because it's a favorite of Mark Yusko. But this shows just a really long view on the history of China and India, or Chindia, as some folks have known, really dominated the first millennium. And then after that, the Western world began to dominate in terms of GDP. And this chart, as well as this chart, often used for why China, in terms of just the tremendous growth of manufacturing that was there. As I mentioned in Newport, the combination of the China 5-year plan for an emphasis on manufacturing, an emphasis to a more consumer-driven, back then it was an export-driven economy, plus the currency affordability really led to their global leadership back starting in the late 80s, early 90s. And you can see here's a chart of the currency. It's inverted relative to the US dollar. So China's currency gets less expensive as we move towards the top of the chart and more expensive as it comes down. So this period of time where it went from 2 to almost 9 really helped tremendously in terms of the ability for China to become the low-cost producer and the global manufacturing center. We talked about the deflation that it exported earlier and potentially now, right now, but we're going to leave that a little bit later. Here you can see sort of the demonstrated proof of what happens when you get a low-cost leader to be the global manufacturing center. This dark line here are durable goods, and you can see tremendous deflation in the pricing over a very long period of time, specifically due to China and just global transportation costs coming down, everything adding up. So where are we going right now? And the forecast for China's GDP has been coming in. We've talked a little bit about this at prior PCI sessions, but the general envelope for the forecast going forward is anywhere between almost 4.5% to 6%. And the latest print that came out just the other day was at 6.2, which was year over year, down considerably from the expected value of 7.1%. Now, there are some basing artifacts with regard to 6.2, but nonetheless, the trend has been coming in. And I showed this in Newport. The PPI for China has just been coming down tremendously. You can see now it's in negative territory, which portends continuing deflation, disinflation in China. These charts just sort of came out. The people from BCA made a good point in terms of you have to be careful of low figures in last year. So that's why the figures look pretty interesting right now. But if you look at a 2-year percentage change, even though the momentum is kind of kicked up just a tad bit in terms of output volume of services and industrials, it's still, the trend is somewhat is on the downside. And finally, I wanted to note, well, not finally, but as far as the numerical charts, the percentage of trade that we do with China has been declining as of late. So this is evidence of the reshoring phenomenon coming in. And you can see that, this kind of greenish line and the red line, Canada and Mexico, have sort of perked up a little bit as China has come down.
Can I ask you, Bill, is there any Chinese money in the Mexican numbers? Because they have been investing in Mexico.
Good, very good question. I would,
You
don't know. Don't know, to be honest.
The answer is yes, Mark. There is foreign direct investment moving from China to Mexico.
Very good. That's why I'm trying to go fast. Anyway, I want to wind up with this one slide. It's quite busy. You all might have a difficult time looking at the text, but this is all in one Reuters article, and it was just headline after headline after headline of, you know, China cuts key lending benchmarks, more stimulus. PBOC will likely further ease monetary policy. Grim picture of the economy. Stimulus policies to be unveiled. Disappointing domestic tourism. You don't see these kinds of headlines anywhere else. All the other headlines that we see are inflation fighting. But here in China, you can see definitely much the opposite. So we're talking sort of disinflation, deflation, potentially happening. And with that, I want to turn it over to Stephen, because he's got some super charts that I really think, highlight some important issues on this. But that gives you sort of big picture history, and then kind of where some of the numbers are headed right now. Thanks so much.
Thank you, Bill.
Thanks, Bill. So following on with what Bill said, we've had a lot of news about China, a lot of it around the politics of China, and meetings recently held by Janet Yellen and Anthony Blinken. And it's really about putting a floor in the deteriorating relationship that we have, which is, excuse me, not a great starting point, but it gives you a sense of how fragile and difficult the setup is. You have right now three big issues in China that I think are driving a lot of the negative sentiment. And I just want to say, before I get into those three negatives, China is, it's always been one of those countries that it's easy to have one point of view on when you really need multiple points of view. So when there's all this negative, I think there's a lot of positives, and it's easy to get hung up on the headlines. But I think they have some structural issues. Weakening demand from global consumers for goods as they shift to services has hurt China, because their manufacturing system has money being sent from China to these countries through their exporting and manufacturing. And now people are focused on leisure activities as the reopening continues. So I think the shift from goods to services is one of the negatives that's weighing on them. I think the consumer confidence is weak, and a lot of that's driven by property. We'll show that in a minute. And in spite of the fact that there's really strong savings rates in China, you're still having this confidence problem because real estate's such a big part of the economy. We'll show that in a minute. And then business investment's been depressed, and I think it's been depressed for a couple of reasons. One is the crackdown on national champions, Alibaba being the most notable one, but it really goes back to the trade tariffs war that Trump started, and it's continued with the worsening geopolitical issues. I think the other thing that's thrown people off is that China didn't reopen the way everyone expected them to. The focus was on quality growth and stability, not just growth at all costs. And I think that's part of the challenge that the market's having in sorting through some of the differences. But keep in mind, China, for all the negative headlines you're seeing right now, is still projected to be the largest contributor to global growth over the next 5 years. And you can see from the chart a very healthy number, with India picking up, the US still strong. I suspect these numbers will not be as positive for China or for a couple other countries as they are. I think India and the US and some of the exporting nations on commodities will do better. I think the European nations will have a bigger problem. I think China's at an inflection point, and I think it's a really interesting time in the Chinese economy as we think about what's going on right now. And you see the list of challenges. It's very similar to the articles that Bill highlighted, with deflation picking up, sluggish consumer spending, The property markets are continue to be in crisis. Exports continue to decline. Youth unemployment hit a new number of 21.3% yesterday. Local debt issues, I'm going to show you a chart on that. Manufacturing is really slowing, and that doesn't get into the longer term demographic issues that they're facing with a terrible birth rate and a rapidly aging population. In fact, one of the strategists considers China the world's oldest nursing home for the challenges that they have in terms of their aging. I think one of the misstated or misunderstood shifts that's going on, particularly around the reopening, but it's part of what Bill was talking about of shifting from an industrial economy to a consumer economy, is they're working on their move up the value chain and shifting from lowest cost production to innovation-led growth. And I think that's a hard thing for the market to adopt to and adjust to, particularly with some of the challenges for the public market companies that fell on the wrong side of the government there. I think where you're going to see this innovation, and Todd's pointed this out in the past, is in the VC area. But I think the last issue, and it's a major one, is this national security issue is changing global relationships. And as long as the US and China are as adversarial as they've been recently, I think that's going to continue to be a problem. But let's look at some of the charts. This shows core inflation, and you can see, this is core inflation. And as you can see that China is way out of step with the rest of the developed world in terms of their level of inflation pressures, looking much more like even below Japan in recent readings. If you look at where they are on a headline, you're really moving to a deflationary mode here. And I think that's one of the challenges, that the cumulative effect of some of the policy mistakes that have been made internally in China, in my opinion, and also the policy mistakes made by other nations, including the US, are creating some of the negative forces here. But I think this is a real issue when the second largest economy is moving that way. We talked about exports, and you can see the chart is a kind of a steady decline. And that's not a good setup for their economy. I think the local government debt problem is one that's getting a lot of press right now. This shows that the majority of the regions have a debt income ratio of over 120%, which makes it a very difficult position for it to be in and for governments to work out of. And one of the challenges is, how does China spread the money around that they have to support the system in a way that's most effective and still deal with this problem, which continues to grow. And it's not just their domestic debt that's a problem. You know, you have $77 billion of Belt and Road debt that has either been restructured or renegotiated in the last couple of years, in the last really 2 years. And I think this problem is what started out as a real positive for China, giving the world an alternative to the Western and US-led approach to governing and governance, gave them an alternative, particularly for more of the authoritarian governments, that gave them a kind of a runway and an ally. And now once you start taking, this debt problem hasn't worked out for either side. It's a problem for China, and it's a problem for the borrowers as well. So I think that continues to be a problem. I think the youth unemployment is one of the bigger structural issues that China is going to face for some time. When you move up, and we've talked about this, the report yesterday was almost 1% higher than it was 2 months ago. So the June report was at 21.3. The April, I think, was 20.4. So a pretty significant move in a very short period of time. And China's graduating, about 11 million college students a year. And recently, President Xi suggested, when there was concern about the youth unemployment rate and that they don't have the jobs they were looking for, particularly as they moved up market, that they should go work in the factories and eat bitterness. That's not exactly a motivating factor for young people to get them moving, but it is a sign of the challenges, I think, that are facing the young people there. So that's the negatives on it, and there are plenty, but you got to keep in mind that China remains one of the most attractive consumer markets in the world. They have a middle class that's growing and continues to grow. It's the middle class that's larger than the population of the US. And will continue to grow there. I think the VC market should remain robust because of the skills and knowledge level and capital that's available in the country. But I think if you want to succeed, you should avoid competing with China in the areas that they've identified as strategically vital industries from their plan, or work with them in their plans. You want to invest in their national champions and keep in mind that their clean energy, they are one of the leaders in that. Their resources around the clean energy transition, around high-end electronics is really strong, and that's going to continue to be both a benefit and a point of friction for the system. So I think there are a number of opportunities inside of China that you can benefit from. But I also think the other side of the coin is the policies put in place by governments, mainly the US with their IRA program and other programs, and even some of the programs China's doing inside their 5-year plans, really identify for global investors opportunities in each society that they can invest in, each market that they can invest in and succeed in. But you also have to keep in mind, China is a leader in patent applications, and I know Janam will tell us that patent applications are only part of the thing. You need good patents, not just a lot of them, and they need to be effective and they need to be adopted and used. But I think with the skill levels and the quality of education and the quality of students in China and the innovation that's always been a part of their culture, I think this is something you can't ignore. And when you go into the advanced areas of technology, China has led the patent applications in most of the major categories for some time. So with all the challenges, there are many opportunities. You can't write it off. It goes through cycles, and they're in one of those cycles where they're dealing with some growth pains, as many systems do. I would argue that the US is doing the same thing right now. So the question that's being asked now for the first time in a while is, does China reach #1, or do they head for a Japan like malaise? And I would suggest that I wouldn't count on China going to a Japan-like number. I think the resources and assets of the nation are real and strong. I think they have the financial wherewithal in the near term to work through their debt issues, and you'll see big opportunities. But the market is being defined for you as where you want to invest. And I think you'll hear from Nick some of the opportunities that he sees. So let me stop there and get us over to Nick.
Just a quick comment. I did post it in the chat, Stephen. The sharp rise in the curve in the Chinese patents corresponds to the year that the Chinese government required everyone from that point on to file in China, regardless of where they live. They have to file in China first.
On the other hand of that, they have had a lot of success for a lot of years of moving up the rankings in the different categories for their quality of their patents. So it's there is a numbers game that you can't be misled on, but that's part of the problem with China, right? You can't it's the numbers.
Yeah, fair point. And that means even if you're in a company, if there's one Chinese applicant, you have to file in China first.
Thank you. Nick?
All right, thank you. Give me 1 second while I try to share screen here. Hang on.
Nick, is it the same presentation that
No, I did some minor edits. Give me 1 second. Sorry. Hang on.
Bill, do you want, while he's looking, do you want to give an introduction to Nick a bit? I don't see Bill though.
I almost owed everybody a beer here. So yeah, Nick and I were colleagues at Morgan Creek. Nick has been there for Nick has been like almost 20 years, something close to that, and was part of the China team initially, and then has assumed the responsibilities for their China fund, which is a a hybrid fund of funds plus direct investments, and has been there, forever, and really a super guy. And now that we've got the slides up, I can hand it back. But I know very few people other than Nick who can speak as well to the situation there.
Well, thank you so much, Bill, and apologies on that sort of tech problem. My laptop was destroyed more than I thought. But thank you for the invite and for taking the time. Maybe there's a lot of data that was obviously very well provided in the prior presentation. So maybe might be helpful if I sort of try to help sort of fit all of that in sort of a framework that I used to think when I think about China. And so three things try to cover today. One is to try to get to sort of the heart of the issue, and it was mentioned earlier. I think the heart of the issue is China's undergoing a tremendous economic transition, and we'll kind of talk about that a little bit more. And that sort of flows into all of the data that the challenging data that you're seeing, not only internally in terms of unemployment, growth challenges, but also externally in terms of geopolitical tensions, et cetera, et cetera. And then second point, we think given have the same view, but think given sort of the resources that China has and the track record that it's displayed over the last couple of decades, that it will be successful in this transition. And then flowing from that, if you believe that they're going to be successful, then where are the opportunities? Obviously, investing behind that transition. So, right. So if you go back in history and look at the development of all of the major industrialized countries, right? So UK, US, Japan, all of them go through very, very similar, three stages. So the first is mass production of, low-tech goods, right? So if you look at how textiles industry migrated from UK to US to Japan to China, and then now to India, Bangladesh, Vietnam, et cetera, that's the natural workings of the economy. Step one, right? So step two is infrastructure building, right? So once you have all of these goods that you're mass producing, you have to have, good logistics. You have to have all the physical infrastructure, the financial infrastructure to allow that to allow the country that's doing that production to become globally competitive. And so you think about sort of, in the UK, obviously the invention of the steam engines pervading every industry. Obviously also thinking through, the railroad barons in the US, post-war reconstruction in Japan, and obviously all the stuff that China has been building. Obviously then step two, right? Or step 1.5. And then on that basis, you move on to the last sort of loop, or the last iteration of the Industrial Revolution, which is mass production of the means of mass production. So all the tools, all the equipment, machinery, both the software and the hardware that the country domestically is capable of producing, to allow them to close the entire loop of that industrialization. So China has completed, you can see China has completed the first two steps on a scale that the world has never seen before, right? So obviously it is the factory of the world by a huge margin today. In terms of infrastructure, it's an interesting stat. China used more cement in 3 years between 2011 and 2013 than the US used in the entire 20th century. So everything that China does, because of its scale, comes, big, right? And so where we are today, I think in China, is we're at this last stage of the development. So at, Industrial Revolution 2.0, it's in the beginnings of trying to innovate, to control, the key technologies that allow its continued industrialization. And so now up until today, right, stage one and stage two, so mass production and infrastructure, China could do this, but just simply by importing foreign technology and equipment, as most countries have done before. But then at a certain point, past a certain point, which is where China is today, the country will be forced to upgrade its economy to survive after successfully completing 1 and 2. And this is true of every country that has walked this path. And it's a natural evolution. And the reason is, this is a bit of a busy chart, but the reason is the standards of living. Standards of living for China has risen significantly, right? So people live longer. Infant mortality drops. So irregardless of the one-child policy, it's just becoming too expensive to have children. Fertility as a result drops. You see this in all developing countries. Population ages, right? The youth have better education. They have higher expectations on jobs. So they don't want to do blue collar labor, wages rise, low tech jobs get outsourced. And so if the country tries to remain at, the lower sort of tech level, eventually you run out of steam and they have no choice but to upgrade. Okay, then now if you try to upgrade, you run into this big problem, right? So the old framework was China was importing all of this advanced, capital goods from, developed countries to manufacture, assemble low-end products. And now China is innovating on its own machines and technologies and all of these high-tech sectors. So if you look at Japan in the 1980s, had a similar issue in that, it moved so quickly in semiconductors that it put Intel out of business into DRAM space. And this is a product that Intel had invented. So obviously the reaction was that, there would be export restrictions and, appreciation of the yen. It was appreciated 50% in 2 years to sort of reset, sort of the rules of trade, right? So then if you look internally, as speakers have mentioned earlier as well, this transition from this, for this economy has also been extremely painful. So the old playbook of infrastructure building, it's almost formulaic, right? So the way it works, and the reason why we have all these local government debt problems, right? So local government zones a piece of land, puts debt on top of it to build it up, and then use that to attract new businesses, issuing sort of tax incentives, subsidized rents, trying to move new industry into that plot of development. And then at the same time, they'll also invite these property developers to build residential units around these areas so that, when the workers move in, they can have homes to buy, et cetera, et cetera. And all of this was built on debt, or at least a very big piece of debt, right? Now, this model, given China's already, relatively built up, doesn't work anymore, or it doesn't work as well anymore. And so the central government's trying to unwind all of this. And the problem is, hence we've seen, over the last couple of years, like, pretty hard policies against sort of real estate, infrastructure building, property, et cetera. And because all of this, or a lot of this, was financed at the local government level, therefore you're seeing all these debt challenges. What about sort of youth unemployment, right? So, to give you a stat, like I'm renovating my home now in Shanghai. The average home builder in China is 50 years old, 50, right? So this is not a job that can yet be automated, at least in any efficient way. So it's still requires people to do that. But no one wants, none of the graduates want to do it, right? So there's a huge shortage of labor in this space. It's the same, with a lot of other blue collar work as well, plumbers, nannies, et cetera. So it's not that there are no jobs in China. It's just that the youth, because they're well educated and they're aspiring for so-called better life, or a different life. They're not interested in these jobs, of the old economy. And so it'll take time, for this economic restructuring to create the jobs that are required to meet the demand from all of these educated young people. And so given this, the fact that, GDP growth is no longer quote unquote guaranteed, like China invests a lot in R&D. It's not the same as investing in debt. You invest in debt, you kind of know it's a mathematical formula, roughly, how much GDP you're going to create. Invest in R&D, may work, it may not work, you don't know. And so given the fact that the jobs are not there for the young people who want it, consumer confidence is going to, has obviously gone through really difficult times. And so I think this is also normal for a country in this stage. If you look at where Japan was going through in its third stage of industrialization from the 1980s to the 88, sort of just before everything sort of fell through. And they made their significant advancements in auto technology and semiconductor technology. Growth in that period of time was roughly 4% annualized. China's target, obviously a little bit higher than that, but falling within that ballpark is not unrealistic. And it's actually, I think it's a pretty, if they actually manage to hit it, it's actually pretty good, just given the scale of China so much bigger. But I think the challenge is, that it will take time for everyone really to get a handle of this sort of new China and this period of Chinese transition before confidence comes back. Just a quick, because a lot of people talk about exports, so just to sort of put it a little bit in perspective, if you look at merchandise sort of trade balances, right? So, in the last 3-4 years through COVID, China literally was producing almost everything, for the whole world, because most other economies, were shut down. And so from 2021, their sort of merchandise trade balances hit record amounts, and it's been hitting record amounts basically every year, for the following year since. So, obviously COVID was a bit of an outlier in terms of now things are sort of back to normal. A lot of it would probably sort of, fall back to what is a more realistic mean. So I think that's one piece. Dropping, 10, 20, 30%, given the huge rise is not unreasonable. The second piece is the type of customers that they're trying to get, as they're shifting their economy. You can see, I think this just shows sort of the chart below, China exports market diversification. Used to be, before COVID, EU was number one. Sorry, I'm talking about sort of total trade. This just shows exports. Today, ASEAN has gained basically that crown. It's number one, EU is number two, US is number three. And then they're also trying to build a lot of networks with other sort of Belt and Road countries in terms of the exports as well. So I think they're trying to change the composition of their customers to make it more balanced. So that's one thing that that is happening. If you look at the chart on the right, the other thing that is happening is the composition of the stuff that they're trading. So it used to be, China was obviously, many years ago, people think of China as sort of exports of low end, textiles, clothing, toys, etc. Even phones, and that's really changed over time. Today, the vast majority of the stuff that the Chinese are exporting, are high tech stuff in the EV, clean energy, etc. An interesting stat. This year, China actually overtook Japan to become the largest exporter of vehicles in the world. So this is, it's a big deal, obviously for China to actually break into that auto market, after struggling for decades. So there's a lot of change that is happening, and I think a lot of it is sort of, I would say, deliberate, in terms of not trying to push for too much, or given sort of where things are. Then very quickly, I'll kind of walk through why we think China has a chance to be successful. And really, I think it boils down to scale. And scale, there's two things: scale in terms of supply chains, and scale in terms of markets. So if you look at, each sort of stage of that evolution, Industry 1.0, it was all about, do you have the labor? And China has that in spades, right? So therefore they were, in hindsight, it was almost inevitable that they would be successful. If you look at sort of 1.5, the competitive advantage for China was the fact that it owned all of the land and all of the resources. So they could just, take over the land and say, this is going to be a road, that is going to be a hospital, that's going to be a port. And they also owned all of the, pretty much all of the people's deposits and savings, in the big banks. So they said, we'll get the banks to lend and loan you to build that road or that bridge or whatever. And that has continued to this day, although what used to be building roads and bridges and highways is now building 5G base stations and different types of digital sort of infrastructure, clean tech energy storage solutions, etc. And so we think, given the relentless sort of investments in cost down infrastructure, that China will continue to have significant advantages in terms of distribution and things like that. And then going forward to 2.0, one of the reasons why I feel a little bit, I won't say sanguine, but a bit more optimistic about sort of this quote unquote unemployment number, which could potentially, if it gets too big too fast, it will be a huge problem. But China has always been a big believer in build it first and they will come. And so if you look at sort of the way they did with infrastructure, for many years, people were saying they're building these cities and ghost cities and sort of bridges to nowhere, et cetera, and even some talking about sort of the Belt and Road. Obviously there are lots of issues, and there are big bubbles as well potentially. And interestingly, one of the biggest bubbles of all, if you go back and read, there's this book, very interesting book that was written about the Great Race, and in it talked about the race for EVs. This book I think came out in 2012 or 13, 15, 16, something around that area, around that time frame. And they were talking about the China versus Japan versus the US, 3 countries that were competing to try to dominate EVs. And the conclusion of the book was China was putting tons of money that was going into zombie projects, and no one, a lot of corruption and investments that that no one kind of knew where all this money was flowing to. And so it was it's just a big waste, and they'll probably end up just kind of losing out and wasting all these resources. Obviously now in hindsight, China basically leads the world in EVs. And so I think part of if it's sort of long way to come back to this, but if you look at sort of the infrastructure that they're building for this next area or this next stage of the industry development, you need a lot of STEM graduates. You need engineers, scientists, et cetera. And China, I think has just decided, look, we're just going to have volume, and we'll see kind of what comes out of it. And so the hardware, the people are all there, and next couple of years we'll just have to see if we're able to create enough jobs, and if these guys could be entrepreneurial enough to create or help China, push China into that next wave of growth. And so there is a proven sort of book, or method to this madness of how China actually utilizes its scale to capture industry. And so, if you look at sort of the top here, basically all of these players, Apple, Roche, International, Tesla, they all come to China because markets are large, but also because the quality of the workforce, and the scale and the cost, all of those things is very strong. And so the moment they come in, what happens is, obviously, they dominate the market, they build the market. But then very quickly, after the supply chain and the ecosystem is somewhat developed, you immediately have, the so-called national champions coming in, right? So you'll have, for example, in the phone, Oppo, Vivo, Huawei, Xiaomi, in EVs, NIO, Li Auto, BYD, Xiaopeng, a ton of these guys coming in. And they typically start at the, basically leveraging off the entire ecosystem that's already there. And they typically start, at the lower end of the market, to be a little bit differentiated. But then over time, that's sort of the bottom and the largest piece of the pyramid. Over time, they'll then move up to compete, internationally. And so obviously in the phone industry now, you can see, even though Apple's still the largest, at one point, sort of before the sanctions, Huawei did actually take the top spot globally. But even with sort of Huawei now being down, China's still, a very large piece of the global industry in terms of OEM. Tesla, obviously, they're now number one. But in China, domestically, BYD, I think, has actually overtaken Tesla in terms of number of cars sold. And the NIO and Xiaopeng and all these other companies are now actually just starting international sales this year. So we'll see how that evolves. So this is China has been able to do this across multiple industries. I mean, this is in some of the industries we talked about, but it's also true in high-speed rail, and a few other choice sectors as well. So what if MNCs decide not to come to China? Well, so you can see this is Tesla. In 2019, Tesla was at the cusp of going under. They had built their factory in the US, in California. They weren't able to mass produce their cars in a cost-efficient manner. Elon Musk is on the record saying he was a couple months away from basically going broke. In swooped China. Shanghai government, actually the premier of China, Li Qiang, struck a deal with Elon Musk. Provided subsidies to build out the entire factory, gave him tax incentives, et cetera, opened up the entire market to Tesla. And you can see, obviously, now China, in less than 4 or 5 years, China now is the biggest factory in terms of number of productions. Like 60% of all cars of Tesla that is being sold globally is produced in China. The entire supply chain, 95%, 96% of Tesla supply chain is in China. So you can see, without China, there would be big challenges potentially, for a company like Tesla, and even for Apple. Recently, Tim Cook was talking about, his next sort of range of products would be VR and AR sets. There's a lot of talk about them going to India, et cetera, but for the most high-end, cutting-edge stuff, it's all still about China. So I think, given the scale, it's a difficult market, obviously, to miss. It's difficult for a lot of these multinationals to get out of this system. But once they get into the system, they build up this ecosystem for China, and then you have these national champions sort of rise from there. So that's sort of the thought. And then so if that's the case, if we think that China would be successful in making the leap towards upgrading its economy, being more self-reliant, then how do we play? And really the solution here is just similar to what the previous speaker had mentioned. Just invest alongside what they tell you they want to achieve if you think they're going to be successful. So I think the two big themes, one is to help or not help, but to basically invest in technologies that allow China to maintain its its cost advantages. So we only invest in stuff that is cost down. So that's one piece. The second piece is invest in technologies that allow China to be to realize self-sufficiency. So if you look across each of these, again, different stages, right? We invest basically in the solutions that allow China to maintain its status quo. So labor-intensive manufacturing, make it less labor-intensive is basically the idea. Invest in labor productivity, things, not so much enterprise software, it's there, but for a variety of reasons, we've not really touched this. But robotics and industry AI, big focus areas for what we think there are opportunities in. Within sort of physical and digital energy infrastructure, there's a lot of opportunities to digitize, China's supply chains, logistics, automate a lot of the things in logistics. Within energy, new energy, clean energy, China leads the world. There's a lot to do around, figuring out, better mousetraps in terms of generations and storage. And then, for the last piece, basically a big piece of it is import substitution, investing in the domestic, technologies in, biotechnology, semiconductors, equipment, specialty chemicals, etc. We do this basically with strategics. So everyone that most of the managers that we invest have very, very strong linkages to the domestic leaders in each of these spaces, because the idea is that we want to partner with them to bring three things. So technology, talent, or customers to China. And so that's basically the idea. And the last slide, I'll just kind of run through very quickly a couple of examples of what we've done and where we think the opportunity is. So figure out, like, the first step, obviously figure out the gaps. What does China lack? And then go find out who has the resources to be able to plug those gaps. So we give like examples of, two sectors. One is in the life science area. Biologics, for example, this company, Innoforce. Biologics is has been huge. There's been tons of money that's poured into biologic, drug discovery and development in China over the last, 5-6 years. But there has been a lack of a manufacturing ecosystem to bring all of these drugs, to the public, to reality. And so, our manager basically went to Thermo Fisher, which is one of the biggest biologics manufacturing sort of companies in the world, and said, look, we want to build a biomanufacturing facility in China. Will you do it with us? And so Thermo Fisher came in, basically gave us their blueprints to build an international GMP facility. And they also opened up their customer base. So these are all international big pharma. And our manager provided basically the local execution, right? So, local government liaison, getting all of the subsidies, the tax incentives, et cetera, all of those things. And then, the local hiring, bringing, sort of bridging in talent. This facility was built actually through COVID, throughout COVID. So we're up and running in 2 years. Everything's sort of up, and now, the company is already revenue positive. Because we did it with a strategic, you go in at the same price as the strategic, basically. So it's just whatever money you've spent building the facility at cost. So, that's one example. I'll give you also an example on the advanced manufacturing space. So we work with a group, NIO. They're one of the largest, car EV car manufacturers in China. And NIO believes in the autonomous driving, I guess, as most, EV car manufacturers do these days. And so they believe that, but the difference is they believe that LiDAR is necessary to realize this vision. So for NIO, for them, this is a mission sort of critical piece of hardware. And so they decided to go and incubate a company that basically produces these LiDARs. So this company is about 5 years old now. Last year was the first year of commercialization of their LiDARs. They printed, they manufactured 70,000 units. This year probably will easily double if not more than that. And every LiDAR that they produce is basically packaged and sold with a NIO car. And again, because this is an incubation with a strategic, you go in, pretty much at the entry level, the very base valuation. And, given NIO has enough heft and scale, today, just after 1 year of commercialization, this is the biggest LiDAR company in the world, auto-grade LiDAR company in the world that has reached mass production. So, the idea is, we see a lot of these types of opportunities working with these strategics, in areas that China desperately sort of needs as it sort of transforms its economy, from 1.5 infrastructure to 2.0 high tech. So I'll just kind of end there, and thank you for listening.
Nick. That was great. Thank you, everybody. Bill, Stephen, Nick, three musketeers here. Well done. So questions, comments? I know there are questions and comments.
I've got a quick question for the group. Great presentation. To what degree is there a negative investor sentiment towards China out there, just from an institutional perspective in the capital markets? Is there a noticeable level of distrust towards China on any level in terms of parking money there?
You're speaking from an American perspective, Andrew?
Yes. Well, I guess globally, but starting with America, sure.
Maybe Nick. I know, Bill, you have to leave soon, but Nick, you want to hit that?
Yeah, sure. Do you mean it from a China perspective, or is there concern around, about sort of confiscation potentially of assets, or?
Just, I guess from a macro perspective, doing business with China, we'll start from an American perspective. Do you see negative investor sentiment out there towards China relative to other places to park money around the world?
Yes, there is a lot of negative sentiment, particularly, I guess, from more developed economies. So Japan, South Korea, the US, Europe. It's obviously a very different story when you go to sort of the global South, Middle East, Southeast Asia, etc. But yeah, I think it's also because of geopolitics, frankly, right? I think there are multiple poles that are being developed, and so you're either, there is a narrative trying to be pushed that you're either with us or not, and so I think that level has made it difficult. But I would say from the China perspective, if you look at China has been very open, or has been trying to be as open as possible towards foreign investment. They need the money, frankly. They blew a lot of money doing a lot of interesting things in COVID. For example, when I was in Shanghai, you probably also read this in the papers, but literally every 2 days we would need to be tested for COVID. So local governments are now in need of a lot of capital. And so if you look at everything that the more challenge, if you look at sort of the track record of what China has done in the face of sanctions, every new challenge that China has received in terms of additional sanctions, etc., they've actually opened up the economy even more. So if you look at their foreign direct investment, there's a restriction list of how many, the types of industries that foreigners are not able to be majority investors and or even touch. And that list has shrunk, very, very consistently, over the last, decade. Every year they remove, 5, 10, 15 sort of sectors from that list. So I think so far the Chinese sort of has been pretty open. But the reality is that, it is a challenging environment today.
Nick,
Yes.
we have a couple questions, but Bill, did you want us to make a final word before you jump?
Yes, yeah. So I've got an internal call, so I'll have to do it. Kudos to my two partners on the panel here. I think one of the things that Nick points out is just there is that huge segment of the population that is the dynamism of China. And lately, it hasn't been as prominent as it was pre-COVID. But if there is an engine that's going to propel China, that's the promise that's right there. So you really have to think about it in two layers. There's the dynamism of that segment of China, and then there's the government policies and things like that. And I think that you have to hold those two in tension in order to understand, the whole picture in terms of what's going on. And I'll leave it there for my colleagues to sort that one out. But thanks everyone.